Hi, this is Mitch Allen with the Advanced Financial Alpha team, bringing you a new video today. I'm going to talk about a question I get a lot from clients: indexing versus active management. Might be an oversimplification a little bit, but I think it'll speak to at least my philosophy on the situation. It doesn't mean that both directions can't work for clients individually or on a case-by-case basis. What I'm talking about here is I have a graph representing the S&P 500. And I'm not sure if most people know what the qualifications are to be in the S&P 500. They're actually not that stringent when you look them up. US based market cap of nearly 23 billion. It's got to be liquid, so it has to trade roughly 250,000 shares per month on average. Most recent quarter has to be positive revenue, and then the cumulative revenue for the year has to be positive. Nothing about competitive advantage, profit margin, other things that may make a company more attractive to invest in. What this graph shows is a separation showing the quality index was established in July of 2014, but they're able to back test it to show what this might look like. Then you have the S&P 500 lowest quintile index, so the bottom 20%. And then you have just the S&P 500. And it tracks the returns dating back to December of 1994. So we're spreading this out over a longer time frame. If you look at more recent history, the last 10 years, indexing has performed very well compared to active management. I know when I started in the business in 2008, what a great time, the beginning of the Great Recession, that first 8 to 10 years, active management really did well for clients. And then indexing started to kind of take over. Exchange traded funds, ETFs, became more popular, easy way for clients to invest at low costs. But when you actually separate these items out, you can see in this graph that investing in high quality stocks, at least historically, has shown to make a drastic difference than just indexing. And as an advisor, I have to look at the greater picture for clients, not just the most recent, even 10-year, 5-year, 3-year, or in the future, 5, 10, 15 years. A lot of times I'm looking out 30, 40 years for clients. Either they're gearing up for that age or even retirees with required minimum distributions coming up down the road. With all that said, I'm still a firm believer that active management can make a huge difference in your portfolio by owning quality stocks versus just owning the index. That doesn't mean that I don't use indexes either. There are plenty of clients I have in indexes. Most of the time, it's in their non-qualified or taxable accounts because we don't want a ton of unwanted taxes being produced by active trading. That would be a great place for indexing and a great fit because, at least historically, we've seen the benefit of having high quality investments versus just the index. And a lot of that is just subtracting out those bottom liars that drag the portfolio down. If you're not working with an advisor, I encourage you to. If you have questions on this or know someone that might, share the video, share my team, and we'd be happy to talk with them about their plan, their individual goals, and investment objectives. Thank you. Have a great day.